up, Supremes? Hope you guys are good. Welcome to an in-depth teaching on how to effectively use the Fibonacci. Now, before we jump in, key things to note here is that this is backtesting. This is not live trading. I like to do backtesting during the weekend when the market is still not moving and I'm not distracted by moving price. Second, the Fibonacci is a tool. It is key for us to note that Fibonacci is a tool. It is used as part of a confirmation. You can't use it on its own. As a trader, you should have at least 4 to 5 confirmations before you can take a trade. Here we're focusing on the Fibonacci. It's not the holy grail. It is used alongside other confirmations. Now, this is the levels that we use at Supremacy Culture. According to our back testing and studying the market using the tool, we have found these to be most effective. But one thing that we need to have in mind when using the Fibonacci, we should never have the concept of it controlling price or price obeying the Fibonacci. What the most important part of the chart when we're doing technical analysis is the price itself. Price is king. Do not be distracted away from price, because this is what Smart Money Institute look at when they're moving the price, when they are pumping liquidity into the market. It is not the Fibonacci's, it's not our trend lines, but that's a topic for another day. Now, when it comes to the Fibonacci, we use the concept of buy low and sell high. What do I mean about this? When we are at an uptrend or a buy situation, we look to buy price at discount. We look at price, we buy at discount. That is the best price possible to buy from. Now, when you're expecting price to move higher, in an uptrend, price will tend to move higher, and when expected to continue moving higher, we'll wait for a retracement back to our 50-60 zone. Let me draw that correctly. So it's from my 1 level or 100 starting level to my 0. So we wait for price to retrace back to a 60-50 zone. This is where price is best discount. This is where price is at its best discount, and this is where we buy to take out this high right here. We look for price to continue to break out this high. Now, to be practical, this will not ideally always happen in the market. These conditions will not always be this perfect, so I just want to map that out and to show you guys why we have all the other levels. Now, since this is the best price possible to buy from, as price continues to go down to trade lower than our 60 levels or 61.8%, it becomes more discount. And I'm not looking for price to trade below here. As soon as price trades below this level, my starting level, I am not involved in the trade. I don't want to take that trade, because that means price might not have enough strength to take out that high and might just trade lower here and continue to break out to the downside. So this is a red zone for me. That's why I've marked it out as red. This is a red zone for me. If price starts to trade here, I don't want to be part of the trade. That's where my stop loss is at whenever I'm taking a buy in an uptrend after a retracement. Now, when it comes to a downtrend, we also look at price the same way we've looked at it in an uptrend. We expect price to move lower. It'll tend in a downtrend, it'll tend to move lower. We wait for the retracement. We wait for a retracement back to our 60-50 level, because that's where price is best premium, where it is best to sell from. Remember, we buy low and we sell high, as how institutes do it. They buy at a lower price and they sell at a higher price. They sell at a premium, they buy at a discount. As long as you have that in mind, you then start to master the first hindsight of the Fibonacci. Now we're gonna be looking at these phenomena in the market going into the chart itself. But one thing that I want you to guys to note from here before we move on is that price is key. It is important how you understand the Fibonacci. It is not the tool that moves the price, but it's price. This tool just helps us to map out to see where price is at and to identify discount and premium when it comes to the market and price movement. Once we have that locked down, let's move to the market and see if we can find some trades. So this is the Euro USD. I'll just use this data that I have here, the past 2 months or so. The market has been consolidating here, so we won't be using this part of the data. Let me just mark that out so that we eliminate that. We wait for an impulsive move outside of the consolidation. An impulsive move outside of the consolidation. And it's very important to know how to place out your Fibonacci so for it to be very effective. For instance, let's look at this impulsive move which traded outside of our consolidation here when the market was trading sideways. So how to place your Fibonacci: you use this high. Let me just point that out. You use this high. I like to use the bodies. I'm more comfortable using the bodies. You can use the wicks if you want. It just will make our data slightly different. Not always that much. I don't like using the wicks when I'm starting off, but when I'm at the very end of my Fibonacci or the impulsive move, I use the wicks to cover up the last high, because that's where I'll be breaking even after the market has taken up that high. I'll show you now in a sec. So this is the levels that I'm using. This is where I'll put the end of my Fibonacci. This is where it's gonna start and this is where it's gonna end, just to make sure that this does not distract, clogs up the price. I'll just remove it for now. So I'll put it at the bodies. Since we are on a downtrend situation, I notice here that we failed to trade above this high. So the market is making lower lows. Price is moving lower. It's making lower lows and lower highs. So I identified that, and so I want to take an opportunity after this impulsive move break out of our consolidation. I'll then take a Fibonacci and place it here at the bodies of these two candles and put the far end, my zero, here at the wick to try and capture price. And I wait for price to come back to premium because we are selling premium, and look what happened. Obviously, as I did mention earlier on, that there are other confirmations, not just the Fibonacci, that I use to analyze the chart technically, but I just want you guys to understand and not be confused on why am I taking the impulsive move. I did mention here that I was still waiting for a breakout outside of this consolidation. That's part of confirmation that I just used right there, so that you guys are on track. And using the Fibonacci just alone here, we can see that we did achieve premium. And so right here between our 60-50, that's where we'll be looking to sell price. As soon as we break this high, as soon as price trades here, I would like to break even. Now let me show you guys how I would facilitate my trades from here. I shouldn't have removed that. So let's say, for instance, I sell as instantly as price pierced my 50 level. What I'll then do is I'll put my stop loss 10 pips above here, above this one level, or 100 here, put it 10 pips. Let's see, let's just cap it at, we have 49 here, so let's make that 59 or 60. It's fine, above these highs here. We might see price trading above here, but this is where our stop loss is at. Always try by all means to make my trade a 1:2. I don't trade anything less than that. So here in this instance, because we're using the Fibonacci, I'll use my negative 61.8 level here, because we're just using the Fibonacci. But if I was using other confirmations, I'll look for another structure, market structure. I'll look to take out profits here, of which it then achieves me a 1:2 trade, which then it's something that I'm most comfortable to trade with. But since we're just using the Fibonacci, this is how I facilitate my trade, because this is the most important part that I want to show you guys. As soon as price trades below this low, I take my stop loss, I break even. Because the mistake that a lot of traders do when it comes to back testing or trading, they're trying to be right. Do not try and be right in the market. It's not about being right. It's about managing funds. It's about facilitating trades efficiently. It's about risk management. It's about assuming risk, because this is a very risky industry and you need to constantly assume risk and to plan out your trades. Now, the Fibonacci helps you to create a more effective trading plan, so that you are able to plan out your trades and trade your plan, and take it from there. Now, let's look for another scenario. Let's look for another impulsive move and see if we can then take advantage of that. For argument's sake, let's just use this impulsive move right here and see what happens when we use our Fibonacci. From the bodies here, or let's just take it here, so that you guys see what I'm talking about. Let's just zoom in so that everybody is still keyed up on what's happening. We use these bodies here. This is where the market kind of consolidated, so we use the bodies of these candlesticks and the wick of this candlestick. To be fair, this is my highest high, so this is a candlestick that I'll use. Oh, I should have used that. Sorry, excuse me guys. This high right here. So what I'll then do is take my fib, place it here at the bodies, take it to the high here, stretch it out to the right, and see if do I achieve. Yes, we did. Spot on, not in between, but right at the 50 level. And this is why I like to enter the 50 level. And this is why I like breaking even as soon as this high is taken out, because we're looking to buy price at discount. Price traded higher above this high, taking out this high. We wait for a retracement from this high right here. When price start to trade lower, we then look to enter at our 60-50 level to buy. Now, this is why it's so ideal for you to manage your trades, to facilitate your trades properly, to manage risk, to assume risk as well, because price never actually extended significantly above that high. Instead, it continued to consolidate and started trading lower, and this happened. So for someone who did not have risk management, they would have lost their funds because of that. So if we had entered this trade right here at our 50 level, we have 10 pips. I will not calculate that. Just want to drive the point home. As soon as this high was pierced or violated, I'll break even on my trade. I'm running a risk-free trade. Some traders would like to take out some of their trade, some portions of their trade, scale out. That's also good. I encourage that. So, and as soon as you are taken out of this trade, you will running a rather risk-free trade instead. This high right here did not trade above this high, so that is not bad. So even when price did come back down, you're still safe because your stop loss was still down here until that happened and started to trade lower. Now let's look at this impulsive move real quick. Just look for two more and let's see how that works. I'll take this low right here and this very high, because this is where I would have seen the market breaking structure right here, starting to trade lower. So I'll take this low and this high. Okay, let me just quickly remove everything that's happening here. We'll get distracted. Yep. Okay, so we take this high right here, take this high, and we stretch it out to the right hand side. Hope you guys are still with me. So price extended high, the impulsive move, we started to trade lower. The best price to buy from is here at discount, our 60-50 level. We would have entered at our 60-50 and had some bit of drawdown because this is discount, had 10 pips below, break even as soon as we trade above that high. Still, we would have had a somewhat good trade. A risk-free trade. Would have lost anything from that trade, made something out of it. It's all about managing funds, remember. Now one more, this was the one we took. Anything here? Yes, let's take this low. After this aggressive impulsive move to the upside, we take our fib. You guys know by now where I place my fibs, because this is very important. Where you place your fibs, it's very key. I found this to be most effective. Let me not stretch it out that far because it's rather confusing. So from this low to this high, price came back to trade in our 60-50 level. I'm not gonna put my risk reward thingy, but here price traded in, stayed for a while, but traded above here, then took out this high, continued to trade higher. Would have been ideal to scale out before this happened, obviously. But another thing to note here is that you will not catch every trade, and the one that's kind of scenario, you will not catch every move. I mean, this impulsive move, did it give us a 60-50 retracement? Let's see, from here to this high, barely did. So you wouldn't have caught that trade. It's not a train smash. You will not catch every move. Do not try and catch every move. Always trade your plan and plan your trades. Do not try to scale in on every trade. Not every trade is ideal. Try to enter high probability trades. Obviously, when you use the Fibonacci alongside other confirmation tools or techniques, it becomes more effective. Some people use your reversal patterns and whatnot, market structure break, and all sort of other things. But as soon as you identify a trend and you know where the market is trading towards, which direction the market is moving, are we in a buy profile or in a sell profile, then you can then apply your Fibonacci. Not when the market is consolidating. I wouldn't suggest anyone using the Fibonacci when market is consolidating and moving sideways, but that's just my 2 cents. Hope you guys found this to be very beneficial, helpful, and if so, please smash the like button, subscribe, turn on the notification bell to keep updated on our next content, free content. Yeah, take care.